Policy uncertainty. Every market analyst on the street now has at least one tally in the win column this year. But few, if any, were bold enough to predict that this year would feature a direct military conflict, a war with Iran. As investors are now painfully aware, Iran is not only a major oil producer, but its geography flanks either side of the Strait of Hormuz, a passageway just 35 miles wide at its narrowest, through which 20 million barrels per day of Gulf oil flow through to the rest of the world. Most relevant for the U.S., West Texas Intermediate crude spiked from just under $60 a barrel at the start of the year to a high of $113 before falling back to around $90 a barrel as of 11:04 on April 15th. Similarly, U.S. stocks sold off about 10% before gaining back roughly 11%, returning to near all-time highs as of 11:05 on 4/15. Those of you watching the video version of this introduction will note my glance to confirm and bookmark the time on those figures, as they have been subject to change and rapidly. This is emblematic of the heightened uncertainty associated with the current macro environment. More broadly, highlighted by this conflict, but unspecific to it, policy and geopolitical uncertainty are now of much greater importance for investors. In our view, this reflects our long-held thesis that the state of play for the world economy is changing at a foundational level, from cooperation to competition, efficiency to resilience, and interdependence to self-reliance. How well positioned is the U.S. economy for this new regime? If the classic phase-by-phase economic cycle against which modern portfolio theory was developed is truly giving way to a less linear, supply shock and event-driven risk framework, investors will likely need to adapt their approach. We bring this all together in our Q2 2026 U.S. economic outlook, Sturdy Under Strain. I'm joined today, as always, by my colleague and partner in podcasting and investment research, Senior Vice President Andrew Korz.
Good to be here, Alan.
Sturdy Under Strain. Not only is that the title of the piece, but it's what's required to write an outlook within the current macro regime. What's been your thought process going into an outlook this quarter? I know a challenging one to write at this point in time, but I think the way that you frame it against our long-term views and kind of frameworks for investors is a very helpful rubric for people to take it in.
Yeah, I think, in times like this when the news, the headlines are really dominating everything and things seem to be changing minute to minute, it's important to take a step back and, to your point, reassess what your foundational beliefs are. We've written about, this changing sort of macro regime for a couple years now. And also just sticking to the data, right? I think there are certain things that you just can't predict or forecast. And, I think sort of number one, sticking to those frameworks that you've developed over time. And number two, just looking at the data, taking it as it comes and updating your priors, as new information comes in. But, there's certain things like wars and conflicts that are truly unknowns. And to your point, writing an outlook in that type of environment is challenging. But, I think for investors, they're, all looking for sort of grounding and sort of how do I change my allocations or adjust based on what's going on.
So a great way to level set would be, what was the state of the economy, or is the state of the economy kind of pre-Middle East conflict? How are we doing leading into this? Is it, a situation where things are accelerating, things are slowing? How do you see things on the ground?
Yeah, I think it was interesting coming into the year. I think we had sort of at the aggregate level, at least, a sort of not too hot, not too cold economy, right? Which weirdly belied like what was a very active year in 2025, right? You think about all of the policy changes from, all the tariff announcements to, sort of an about face on immigration policy. You had the longest government shutdown, I think, in U.S. history, right? And you had all of that in the span of 1 year. But then you look at growth, right? And GDP oscillates because of all the trade data. But if you kind of look at the more stable measures like private domestic demand, it was up 2.4% for the year. And if you break it into halves, right, it was up 2.4 in the first half, 2.4 in the second half, right? So remarkably consistent growth through all of this policy uncertainty, which you mentioned. I think, it also belies some nuance at the detailed level, though, right? So, if you consider the drivers of growth relatively narrow, right? You've got all these wealth gains in rich households. They've been driving consumption. You've got the AI boom at the infrastructure level, which is helping to drive business investment. So the drivers of growth have been relatively narrow as well. So I think people came into the end of this year, the end of 2025, because of those factors, and the sort of eerily, quietness of the headline numbers, saying this has to be an inflection point, right? Something's got to give here. On one end, you had the reaccelerationists who said, look, we've gotten 175 basis points of Fed cuts. We're probably going to get more this year, right? We've got the one big beautiful bill that's going to add a fiscal impulse this year. We've got the AI boom, which is going to continue, and hopefully productivity gains in the back of it, right? The economy is set to reaccelerate this year. That was sort of, I would argue, the dominant view, but that was sort of camp one. Camp two was sort of the skeptics, right? And they looked at the, slow, gradual weakening in the labor market, or, what they believe to be a weakening in the labor market. And they said, we are sort of in a slow motion cyclical slowdown. We've got pressure from tariffs and immigration policy on growth. We've got all this policy uncertainty on top of that. We are in a cyclical danger zone coming into this year. And I think 3+ months into this year, leaving the war aside for now, neither has really come true, right? So on the reaccelerationist side, the fiscal impulse from the big beautiful bill hasn't been quite as big. The tax refunds haven't been quite as big as people expected. Still good, but not quite to the extent that we thought. The Fed, obviously cuts have been priced out, right? So that sort of idea has, for now, been tabled. But then on the skeptic side, the labor market data that's come in this year has been, I would argue, better than expected. So there's really no sign of concerning weakening in the labor market. So I think we still have this economy, right, that's like stable, resilient, able to deal with shocks, but not necessarily firing on all cylinders right now. And it's one, I would remind people, where growth is 100% reliant on productivity, right? We're not really growing the labor force at all anymore because the immigration numbers are so low, and because of our aging demographics, right? So it's really predicated on this productivity growth, which is, again, a big part of what we write about in the outlook.
And, I think one of the things that people have really focused in, it's always a focus when you're talking about what's the state of the economy, but I think acutely more so because of the risks of AI going forward. So, the anxieties around the labor market. I think people are hyper-focused on any even sort of minute change in data and sort of leading data. College graduates, are they getting hired into their fields? What's the unemployment rate for younger people? And I think, what we've seen so far, as you outline in the outlook, is, the labor market's been very steady. The labor market's, had a little bit of shift. We had a white hot period, a couple years ago. That's moderated somewhat, but you're still seeing, some meaningful real wage growth. Productivity gains are significant. There's a question of the extent to which labor's participating fully in some of those productivity gains. But that's something that sort of tends to level out over time as well too. And so if we were to sit and say, okay, let's hold aside the concerns about the future, which may be very real as it relates to AI and job disintermediation and employees' ability to negotiate higher wages. What is the health today?
Yeah, I mean, look, the labor market is worth talking about because it's basically the whole ball game, right? The U.S. economy is 70% consumption. How do people fund their consumption? They fund it through the income that they make, and that is very much predicated on the health of the labor market. So this is truly the ball game, right? There's you sort of mentioned the multitude of things that are hitting the labor market right now that makes it really challenging, especially challenging, I would argue, right now, to disaggregate and really sort of come to a firm conclusion on the quote unquote health of the labor market, right? You've got immigration, which is sort of weighing on both the supply of labor and the demand for labor, right? If you have fewer people coming into the country, that lowers demand for goods and
Mhm.
services, which ultimately lowers demand for labor. But obviously the supply is the bigger shock, right? We've just got
Right.
fewer people entering the labor force. AI, which you mentioned, I think it's still too early to make a definitive claim, but certainly there seems to be at least a reticence among some areas of the knowledge economy to
Mhm.
hire. You've seen that across white collar jobs for years now, right?
Mhm.
And then you've got some cyclical weakness in parts of, I would call it like the goods economy, right?
Mhm.
Like manufacturing, construction, transportation, where hiring has been slow because those parts of the economy have been hit by high interest rates, tariffs, et cetera. And because of all these factors, you've had a significant slowing in the hiring rate, right? We've
Mhm.
gone from, hiring 200, 300,000 people a month
Mhm.
in, 22 and 23 to closer to 20,000 a month now,
Right.
right? So that change is significant. It causes some concern, understandably, but there's sort of three things I want to point out that I would offer as reassurance that while there may be, some distributional issues here, the aggregate labor market remains pretty healthy. So number one, initial claims remain incredibly low, right? These
Mhm.
are people who are filing for unemployment insurance for the first time,
Mhm.
right? It's basically at a cycle low right now. So if you compare levels from early 2023, when again, we were hiring more than 200,000 people a month,
Right.
right? Initial claims have not budged from the level they were at then, right?
Mhm.
So the decline in hiring since early 2023, which has been significant, we could argue has been mostly due to a decline in the supply of
Mhm.
labor, right? Not the demand. The second thing I would offer is the most important data point here is the unemployment rate,
Right.
right? The unemployment rate is basically flat over the past year. It is up only 0.7 percentage points since the end of 2022,
Mhm.
right? That is a minuscule rise relative to the more significant rises we normally see around recessions,
Mhm.
right? And more to that point, about half of that rise has been due to people actually entering the labor force, right? Not because people have lost jobs.
Mhm.
Our prime age labor force participation rate today, right? So basically how many people ages 24 to 55 either have a job or looking for a job
Mhm.
is higher now than it was in 2019, right? So that
Mhm.
tells me the labor market is robust enough to bring people into the labor market.
It's a helpful level set. I think some folks have latched on to maybe some emerging data points that are, sort of, forward looking around certain trends in terms of what jobs people
Yeah,
are, pursuing and what people are studying in college and some of the more kind of forward looking labor market indicators. And what I would caution it there is that, that can be helpful in terms of maybe this is where things are heading, but, it's not strong enough at this point to really suggest a trend when,
right.
as you just outlined, a lot of the fundamentals remain very sound.
Yeah, and to your point, wage growth, like if you adjust it for the composition of industry, is still close to 4%. That's a percentage point above where we were pre-COVID,
Hmm.
right? So that both is funding consumption, that's
Right.
allowing people to keep their consumption levels, high and growing at a reasonable rate, but it's also putting some modest upward pressure on inflation still too. So I think this is a labor market. It's not a great labor market. It doesn't
Hmm.
feel good to be looking for a job, certainly, and you see that in the
Hmm.
consumer confidence numbers. But at the aggregate level, in terms of like, is it strong enough to continue to drive solid consumption growth? The answer is yes.
So you touched a little bit on, the impact of inflation within this paradigm as well too. Obviously, right now with the war in Iran, we're seeing some commodity related price shocks, across the energy complex. There are also other, forms of commodities that are being impacted as well too. Helium exports from Qatar, for example. How do we see the current commodity price shock, affecting the economy, at its current state, and potentially if this continues to last
Yeah,
for some
never thought we'd
time?
talk about helium on this podcast, but here we are.
A lot of hot air.
We're blown. That's right. So I would say, there's sort of direct impacts and indirect impacts,
Yep.
right? So the direct impacts are obvious: higher gasoline prices for
Hmm.
consumers, higher diesel prices for transportation, higher
Hmm.
jet fuel prices for airline travel. Um, you could probably consider the direct impact, the sort of effect on goods prices from higher transportation prices as
Hmm.
well. But then there's also the indirect effects, which I would sort of group into three categories. Number one being we've priced out Fed rate cuts because inflation is expected to rise. Long-term rates have gone up because of that. That has pushed mortgage rates right back up. They came down below 6% on average, which was a real positive, I think, right? Now they're back up closer to 6.5% at just the wrong time when we're entering the spring housing market. So that's a challenge, right? That could be an impact in Q2. The second thing is just broad uncertainty around, okay, what are my input costs going to be? If you're a consumer, maybe you save a little bit more, right? If you think your gasoline prices are gonna stay high. If you're a business and you think your input costs are gonna go up, maybe you hold off on hiring or you hold off on investment, right? And then the third thing is just sort of the impact on global growth, right? Here in the U.S., we're much more insulated. Globally, especially in Asia, you're seeing some outright shortages, right? People being asked to stay home from work. Eventually, you could get to a point where some factories might be shut in, right? These are real impacts globally. And again, in a sort of interconnected system, we're insulated somewhat, but certainly not immune to these types of hits to global growth. So those are the sort of indirect effects that may take some time to see in the data, but certainly if this conflict remains, relevant for a while longer, we'll start to trickle through to growth.
And what I think is really important is like people talk about this concept of uncertainty a lot, and like markets don't like volatility, markets don't like uncertainty. People kind of have, an idea of what that means. But I think what you've just said is very specifically, if households, because they don't know what their next energy bill is going to be, they don't know what they're going to have to pay at the pump over the next few weeks, they might try to save a little bit more elsewhere. That's spending that, is not just being diverted from other portions of the economy, but might not be happening because you see the need to save a little bit more ahead of time in expectation of those costs. And the capital investment portion of it as well, too. If I'm a chips manufacturer and helium is one of my, inputs into that process, is now a point in time where I continue to proceed with a major investment into new, manufacturing capabilities or to expand a plant, expand production? Or is it a point in time where I kind of hold off and say, okay, I've got to get a little bit more certainty around the cost side, of this project financing that I've got underway?
Yeah, and certainly we saw that around the tariff announcements, something similar as well, right? The last thing I would say is there certainly will be potentially some positive impacts if oil prices stay high to, I shouldn't say anything positive about a war, but the profits for energy companies will probably go up if oil prices stay high, right? Whether that catalyzes more investment, more wells being dug, we'll see. But that type of investment, it's just not large enough to offset the meaningful impact, especially from higher gasoline prices, right? Gasoline spending is well over 1% of GDP, so it's significant. So the net effect on the economy will probably be negative. It'll just depend on how high prices stay and for how long.
And, making those significant investments in an environment, and this is where I want to kind of shift the focus. I think this is a critical part of the piece is, when you're making those investments in a situation where you're responding to supply shocks, what that leads us to is really what we describe in, the economic outlook is a breakdown of the classical cyclical pattern, the kind of boom bust cycle, that's really defined the last kind of post-World War II era of investing and of economies and of the economic macro system. And so, we describe within the piece, a new macro regime is one that with less cyclicality, but more shocks, sort of an event-driven, policy-driven environment as opposed to the classic, demand-driven cycle, in which there's a kind of more clearly defined interest rate curve, with different phases of the cycle, and different investable assets have a well-defined utility that align to specific phases of that cycle. And many of the past, vulnerabilities that the U.S. had to this classic cycle, have been improved upon. But on the other hand, the expected contributors, to prospective growth are narrow, like you said at the outset, and capital, both on the holders and providers / intermediaries of it, have become increasingly more concentrated. So it's an interesting dynamic where you've got the shifting kind of cyclical factor, but you've also got a shift in how the U.S. positioned against this new backdrop.
Yeah, it's interesting, and we've been sort of talking about this new macro regime for a while now. I think, look, national economies are built around the geopolitical regime that exists, right? So if you think about going all the way back to the 60s and 70s, like we had wars, we had significant inflation, we had energy shocks, right? The economy was very, very cyclical, right? Expansions tended to last like 3 or 4 years on average, right? The macro regime that began in the 80s, and I would argue kind of ran through the 2010s, was sort of a response to that, right? It was dominated by the U.S., who was the undisputed sort of, it was the unipolar moment, right? After the Soviet Union fell. And I think the U.S. used this period to drive, what we viewed was healthy globalization, which I think it very much was from an economic perspective, right? And the U.S. also used this period to sort of, to your point, make its economy less cyclical, right? And the ways that it did that, offshoring manufacturing to markets with lower labor costs, right? We certainly did that, and obviously there were some negative impacts from that. But a services-oriented economy is much less cyclical than a goods-oriented economy, so that's obviously a big one. You mentioned the shale revolution, which turned us from an energy importer to an exporter, sort of insulates you from energy shocks in a certain way. The fact that the U.S. dominated the trade and financial system, right? It sort of created this demand for U.S. assets and specifically U.S. Treasury assets that allowed the U.S. to respond to downturns in a significant way from a sort of federal government fiscal perspective. And then you have more recent phenomena, right? The almost all fixed rate mortgage stock that we have makes the economy less rate sensitive. And very recently, you've got an AI tech capex boom that seems to be, sort of totally divorced from the economic cycle right now. So all of those things, I think, have made the U.S. economy more resilient, less cyclical. On the other hand, that globalization also created these choke points and these concentrations that you mentioned, right? So you think about how decisions were made in that environment. If Taiwan was the best place to manufacture advanced node semiconductors, just do it all there, right? If China was the best place to manufacture iPhones or refine rare earths, right? Just do it all there, right? In Asia, if you got the cheapest LNG from the Gulf countries, just buy it all from there, right? And that made sense in a world where you didn't really have to worry about these types of shocks or nonlinear events, right? But now you do, and I think what we're seeing is these transitions are really messy because the geopolitics and the domestic politics move a lot faster than the economic reality on the ground, right? So you've got sort of this increasingly uncertain global regime colliding with a concentrated, hyper-efficient global economy, right? And that's creating all these disruptions and these supply shocks that we're talking about. So I think this is probably the new norm. I'm open to, folks disagreeing with that, but I think we're in this, we've seen over the past 6 years, multiple supply shocks. The U.S. has been able to sort of remain resilient through all of those. But I think ultimately we're entering a world where the U.S. is, again, the economy is very resilient, very dynamic, but also operating in a world, and I would argue shaping a world that is, more nonlinear and more event-driven and less sort of driven by the traditional understanding of how cycles work.
Yeah, and I think one of the things that's relevant for us as a firm involved in the private credit markets is that, if you have a financial system that is like your financial system needs to adapt to this new kind of reality of the situation as well too. And, a system that is much more highly leveraged and kind of overexposed to shocks to where, you can have kind of the forced asset selling process is a critical risk if that's going to be the environment that you're in. And, one of the things that you cite within the paper is that, private sector balance sheets have improved materially over the last decade. I mean, I know some people that call it the great deleveraging. But in 2008, U.S. non-financial private sector debt was 172% of GDP. Now in Q3 2025, that level's fallen all the way down to about 140% of GDP. You have household wealth that has grown immeasurably over that period of time as well too. So kind of like the equity among U.S. households, the ability to kind of withstand some shocks, and also the increase in capital held by the major depository banking institutions within the country provides some additional buffer relative to the way that they were positioned pre-GFC. When, super high levels of leverage, exposed them to, more rapid runs, more susceptible to even minor deterioration in asset prices. And you've had a broadening of the lending ecosystem to include private credit and other non-bank lenders that are typically
Yeah.
much higher equitized within, their balance sheet, providing
It's a more diversified lending
exactly.
landscape. Yeah.
And it allows not just the safety from a equity security perspective, but it provides like diversified lenders that across the cycle, across through shocks, some lenders pull back, others are well positioned to kind of fill that gap, and it kind of smooths out the provision of credit into the economy,
Yeah.
which is a very healthy.
Yeah. We saw this in 2023 after
Exactly.
the sort of uh, banking issues that we saw. Private credit stepped in there.
So for the next portion of our conversation, we wanted to bring in an expert. A lot of what Andrew and I have talked about involves the macro. There are certainly implications from the war in Iran. We're blessed to have with us today Jason Cole, who's the head of public policy for Future Standard. He spends a lot of time in DC, very attuned to a lot of the policy changes, that are going on in government that impact the financial system, and also, well informed on what's going on abroad. And so, Jason, your expertise will be very additive to the conversation we've started here today. And thank you for joining us.
Thanks, Alan. Delighted to be here. Good to see you guys.
So, as folks who've listened to the episodes before, Jason is a terrific interview, very knowledgeable, deep knowledge, and he sticks, very specifically to like, here's the framework of what's going on. And as it relates to the current situation in Iran, where there's a lot kind of back and forth and unknown, I'm hoping, Jason, that maybe you can kind of set the table for us. It's April 15th. Again, I'll use my third time stamp of the episode. Just lay what's happening on the ground. What's the state of play with the war in Iran?
Yeah, we started out with an easy question, right? I mean, look, I think the problem in answering that question is that there's very few of us literally on the planet that know that, and that most of us have to unfortunately rely on the news,
Mm-hmm.
which as a vehicle for determining where things stand. And there's at least, two points of view. And I say at least underscore that are being driven through these news narratives with two different agendas, at least two different agendas at play. And that really, I think, distorts our ability to quote unquote determine where things stand at this moment in time. That said, we have to be really careful here that we don't get lured into, particularly as market participants. As humans is a different matter, but as market participants, we have to be careful to not get lured into sort of the bi or even multilateral tribal propaganda things that are going on in the news right now. And remember and keep in mind that old adage that the first casualty in war is the truth. And so that said here, I think we can make a few objective observations. Number one, we'll just start with the calendar, right? On February 28th, we, along with the Israelis, conducted a joint operation that very swiftly and immediately decapitated the Iranian regime at that time. And I think that's important to underscore here because that regime has been replaced. This is a different engagement than the one we saw in early January with Venezuela, where there was one clear leader was
Mm-hmm.
plucked out of there and onward and upward. This is a very different situation. There's a very different dynamic on the ground, a different political environment, and a way that the regime structured itself. We then, along with the Israelis and some other allies, began a degradation campaign on Iran's air defenses, their offensive capacity through, the depletion of their navy, their ballistic and conventional missile and drone production. And we also started to deplete and degrade their internal security apparatus. And I think the goals here were ultimately to cripple Iran's capacity to project power, and to frankly set the conditions for an internal popular uprising that we hoped would lead to a regime change, to help move things along. Now, Iran, as we know, responded with what I like to describe as an attrition campaign, where they really, I think, designed to inflict maximum pain on the Gulf states, to try to get them to push us, the United States in particular, and somewhat to the Israelis, to move to the negotiating table, and also to impose a war premium on supply chains and energy, by taking advantage of huge asymmetries that they have in this war. And by the way, modern warfare, we've learned that
Mm-hmm.
through Ukraine, Russia, right? Where it's you take a $20,000 drone and put it up, where there's a virtually unlimited supply and very quick production cycles with a $4 million Patriot missile, where the supplies are a lot more limited and it takes longer for them to get back online. That is the definition of asymmetry. And the Iranians have, for really for worse, done an effective job of taking advantage of those asymmetries. And so I think today, objectively, we can, I think, easily assess that their military and leadership have been massively depleted, that we've made a ton of progress in that particular mission and have a lot of leverage to move forward. But I think we can also objectively say that this thing probably isn't done, principally because as things stand today, for the fourth timestamp, April 15th, the Strait of Hormuz is closed and it remains a vulnerability. And for all intents and purposes, Iran continues to have access to enriched uranium. We think that it's buried under, meters and meters of rubble. But they certainly also have a strong desire to continue developing that nuclear program. And so, to the extent that the Strait and restraining Iran's nuclear ambitions are end games here, I think we're still a fair ways away from that. And now we've entered this blockade piece, which is an interesting way I think the administration has escalated without escalating in a kinetic manner and maybe
Hmm.
driving the Iranians back to the negotiating table where we can deal with those other two objectives. And so I think that's where we are today. The market seems to have responded very positively to the blockade. We hit almost new highs yesterday. And the intraday here has been violent. I don't know, need to tell any of our listeners that that's been the case for the last 6 weeks, but I think the market is beginning to see the beginnings of the end as we get, as we move through this conflict.
So, this is coming just a few days after the peace talks in Pakistan and Islamabad. Each side had their sort of list. I think it was a 10-point plan from Iran, a 15-point plan from the U.S. There didn't seem to be much agreement on on many of the points. Both kind of came away saying, this was an unworkable framework. It's a great sign that, some diplomacy has occurred, but, how far apart, the Iranian regime and the U.S. are on what is needed to kind of bring this thing to a close, seems to be a wide moat at this point.
No, I think that's right. And I look, I was encouraged, and that more now we're entering opinion land, but I was encouraged that the vice president was the one leading those negotiations. He's been, probably within the administration, the largest, for lack of a better word, critic of this engagement. So having him as the face of negotiations, I think, is an important signal. But I agree, Alan, that we appear to be pretty far apart, and that there are some, I think, again, trying to interpret through the news, there appear to be some pretty large red lines that we have in these negotiations. I think number one is, we need the unambiguous opening of the strait, right? No escorts, no tolls,
Hmm.
none of these silly things. And by the way, even then, I remain concerned that to the extent that a regime that we see today remains in place, you have a cloud and a threat that commercial activity could continue to be at risk in the Gulf.
Hmm.
And that could continue to carry a risk premium for somebody wanting to insure the boat or the cargo on that boat. And so
True.
we need sort of in the first order, sort of a minimum viable product here is an
Mhm.
unambiguous opening of the strait. I think the second big red line, and probably the one we're going to have the most difficulty on, is around the Iranian nuclear ambitions.
Hmm.
And they have a very clear desire to pursue that. And we have an absolute and important and understandable, and in my view, red line to say, no, you cannot have a nuclear bomb. And
Hmm.
I think may end up being the real rub as these negotiations move forward here. And I'm honestly not sure how that one ultimately gets resolved.
Yeah, we won't press you to speculate on that. I think sometimes unknowns are just what they are, and you've got to kind of look at the facts around the situation and, not dive too deep into scenario analysis, but, kind of be prepared for whatever eventual outcomes may lie. I think, Andrew, on that topic, I'd kind of turn to you for a closing thought, just in terms of, from a market's perspective. Obviously, we've talked the commodity disruption angle. It seems like markets are pretty optimistic at this point. Um, you know, what would you kind of, estimate as, potential implications, how folks should be thinking about positioning, around some of this uncertainty?
Yeah, I think from an economic perspective, we laid out a few scenarios in the outlook.
Hmm.
One of which, the sort of conflict is wrapped up and commodity prices renormalize. In that type of scenario, you have a sort of time limited jump in headline CPI, no
Hmm.
impact to core CPI, core inflation, and maybe you get 20 basis points of hit to real GDP right now
Hmm.
this year, but it's fleeting, right?
Hmm.
And that's I honestly I think sort of what markets are pricing right now. If you look at consensus forecast for GDP growth this year, they've fallen about 20 basis points, so right in line with that.
Hmm.
The second scenario would be something where, as Jason mentioned, we carry sort of a durable risk premium in the oil
Hmm.
markets, where oil kind of sticks around like the 80s or low 90s for the rest of this year.
Hmm.
And in that scenario, maybe you get like a 40 to 50 basis point hit to real GDP,
Hmm.
a more extended rise in headline CPI, which of course will be something for the Fed to watch. Generally
Hmm.
speaking, we consider central bankers to look through energy shocks.
Hmm.
But in this case, I think given the fact that inflation has been above target for 5 years,
Sure.
they need to be more considerate of the potential that inflation expectations at the business level and the consumer level get to somewhere that's more concerning. And then the final, most draconian version, prices, the Strait stays mostly closed.
Hmm.
Prices, on oil are 150 or higher for the rest of this year. And that's a challenging scenario where maybe you get a point or hit or more to real GDP this year. Headline CPI goes to, above 5%.
Hmm.
And that's a really challenging outcome. We're not sort of taking a view on exactly which of those is most likely, but I think looking at things in a sort of scenario-based analysis is a nice way to gauge the sort of distribution of outcomes.
Another sort of policy geopolitical factor that is highly influential, and it's been less talked about of late. Obviously, there have been other things in the
Yeah.
news, as we just covered, but the tariffs. He's been the most pro-tariff president since McKinley. That was obviously something he wanted to be a feature of his presidency. There was the recent Supreme Court ruling that curbed back, some of the leeway that he had to implement on the discretionary side, some of the tariffs. But there have obviously been plans underway by the administration to sort of re-architect the tariff regime. And I'm curious, Jason, this is something you've been following very closely. What does that look like? What sort of new provisions of law are they looking to rely upon, as they go about sort of re-implementing, re-architecting the tariff regime?
Yeah, sure. And we've talked a lot about this. Just go back through the archives here on the tariff policy. I think it's important for our listeners to remember that there are two tariff regimes, right? One was aimed at sectors, steel, aluminum, copper, lumber, semiconductors, pharmaceuticals, a number of sectors representing somewhere between $1.5 trillion to $1.8 trillion worth of imports into the United States. None of those tariffs were implicated under the Supreme Court decision in February. Those tariffs were enacted under an authority, Section 232 of the Trade Act, which is extraordinarily solid, and there's very little legal ambiguity. The administration has all the authority in the world to do those sectoral level tariffs. What was implicated were the so-called reciprocal tariffs, tariffs on
Hmm.
countries from around the world that were enacted under a statute called IEPA, the International Emergency Economic Powers Act. And IEPA flat out doesn't mention the word tariff. And in the simplest terms, the Supreme Court said, statute says you can't do tariffs. In fact, doesn't mention the word tariff. Therefore, we don't believe it's lawful for you to wage tariffs under this particular regime. I had long said for the better part of a year, I was saying that the Supreme Court was going to overrule these IEPA tariffs. They did, in
Hmm.
fact, do that. I then also have long gone on to say that the administration would pretty immediately, and they did so within 2 hours
Hmm.
of that ruling, begin to rebuild the tariff wall. This is a policy the president is 100% committed to. And we can get into the reasons why, but he's very committed to the policy. And again, within a couple of hours of the Supreme Court decision, the administration instituted and began reconstructing that wall through Section 122 of the Trade Act, which allows presidents to levy tariffs up to 15% for 150 days. And so today we stand at 10%. Every week or so, you'll hear somebody in the administration, it's usually Secretary Lutnick, that says we're going to 15. I have my doubts that we will. And the reason for that is because the way that statute reads is that the tariff level has to be applied uniformly.
Hmm.
And we have a deal with the UK at 10%. And I'm hearing that the UK has said, "Hey, guys, we a deal is a deal, and if we were to go to 15, that would upset that balanced deal, and I think we're going to stick at 10 because remember, this is just buying time till July 24th when that 150 days expires, for the administration to be pursuing other actions. And in fact, about 3 weeks ago, they initiated." Investigations on a separate tariff authority, Section 301, into around 60 countries that I expect will be complete, into July, mid-August, maybe it bleeds into September. But I think by the end of the third quarter, we will have totally and fully reconstructed the tariff regime and be back at a sort of an effective weighted average tariff level in the mid to high teens, sort
Hmm.
of where we were on February 20th when the Supreme Court ruled. It will just be through different authorities. And it could call into question some of the deals we have in place. I think that's something for investors to pay attention to is whether or not these deals that have been constructed, particularly the investment commitments that countries have made, whether or not they remain durable as tariff levels reset. So stay tuned.
And when you think about the implication, Andrew, for what's happening with inflation, for goods prices, for trade in general,
Hmm.
this would seem to be a little bit of a hostility toward trading partners. Some may view it that way, some may not. I think there's mixed views, maybe. But how would you kind of characterize, the economic impact and, especially on inflation?
You know, when Day happened almost exactly a year ago, the effective tariff rate, Jason, was expected to be what, 35, something like that, right?
Yeah, it was. I don't think it was quite that high.
Okay, 30 maybe.
Yeah, somewhere around there.
Yeah. So I think the prognostications in terms of what that meant for inflation were severe, right? We
Hmm.
were going to see a significant increase in inflation. I think we've seen a more moderate impact on inflation, not because the pass through didn't happen, but
Hmm.
because the rates came down pretty significantly from that initial
Hmm.
announced level. So the Fed actually recently just came out with a great research paper on this. And what they found is basically tariffs have forced one-for-one price pass-throughs to consumers, right? So basically 100% of the tariff cost has been passed on to consumers, and that generally happens over a 7-month process, right? So, and that's on average. That's not for every product, but on average, about a one-for-one pass-through in about 7 months. Tariffs so far have increased core goods prices, right? So X energy, core goods prices by about 3.1% on their own versus what they otherwise would have been. And that increase in goods prices has driven core PCE, so the overall core inflation measure that the Fed follows, by about 80 basis points, right? 0.8%. If you consider where core PCE is now, it's about 3. It's expected to be probably 3.1% next month. You're talking about a meaningful portion of the excess inflation coming
Yeah.
from tariff impacts. Now,
Yeah.
that doesn't mean that inflation is in a box and everything's great. And once tariffs are set for good, if they're ever set for good, that the Fed can go back to sort of cutting because inflation's a target. I think we have real skepticism that
Hmm.
goods prices go back to deflation
Hmm.
the way they were pre-COVID, right? There's a lot of reasons to think that won't happen, whether it's, deglobalization, reshoring, these supply shocks that seem to be happening, pretty consistently. And then the services side isn't looking all that great either.
Hmm.
So I think there's a lot of reasons to still be concerned from an inflation perspective, and the Fed clearly is.
Hmm.
That being said, I think we've probably seen the majority, not all, but the majority of the pass through of tariffs from a core inflation perspective.
And, this probably just makes monetary policy all the more challenging. Like, not only do you have a commodity price shock right now, you've got, increased prevalence of supply side shocks that you're contending with, but you've also got, 80 basis points of, additional inflation from, tariff policy that, is kind of unsteady,
Yeah.
changing rapidly, may not be sticky. So you're looking at like your X commodity shock, X
Right.
tariff
Exactly.
inflation, and you're like, okay, things are pretty good, like maybe justifying rate cuts. But then you tack on all these additional premiums, and you're
Yeah.
back to a level where, not many Fed governors would necessarily be comfortable cutting into that
Yeah.
environment.
We've sort of been in Schrodinger's inflation for like
Yep.
4 years, where like if you exclude 13 different things, you can kind of get to your preferred outcome,
Mhm.
whether you thought inflation was bad or it was fine or somewhere in the middle. You could always get to your preferred number by just
Yeah.
excluding things. The reality is we're above target.
Mhm.
We've been above target for the better part of 5 years.
Mhm.
And the Fed's ultimate concern right now, again, is letting inflation expectations get out of control.
So no core/core inflation measure on the horizon.
Believe me, we still look at all of it. And again, you can tell the story that you want. I think the balance of the data, though, suggests that we're closer to, much closer to target than we were 2, 3 years ago, certainly, but still not there. And the risks are to the upside, not the downside.
And it's obviously an interesting time for the Fed. You've got Kevin Warsh, who's been nominated, beginning the confirmation process here soon. Jason, you're very familiar with what that process looks like. You've been very helpful to Andrew and I in terms of educating us on all the vicissitudes of Congress and what Kevin Warsh might face throughout the confirmation process. Would be grateful for your view on where things stand today and what lies ahead.
Yeah, the actually his nomination hearing was supposed to be tomorrow. That was delayed. There was a delay in getting his financial paperwork up to the Senate Banking Committee. It's a substantial um, set of financial paperwork. I aspire to have as much financial paperwork as Kevin Warsh does. But the paperwork got up there yesterday. The hearing it has been scheduled for next Tuesday, the 21st of April. It's interesting. All right. There's the Senate Banking Committee partisan makeup is 11-10 Republican. There is one Republican member of that committee, Senator Tom Tillis from North Carolina, who is up for reelection, has chosen not to run for reelection, and so you can consider him as a free agent. And he's spoken his mind on a number of topics, but on this one in particular, he has said that he will not vote to confirm anybody. It doesn't, Mother Teresa wouldn't get Tom Tillis's vote next week. And by the way, the vote doesn't have
Well,
to take place next Tuesday. It can
she's
take
probably not great at monetary policy, admittedly.
Right, fair, but he would not vote for anybody insofar as the investigation, the DOJ investigation into Jay Powell is it remains open.
Sure.
Right. And so you've got this sort of standoff between the administration and Senator Tillis around this DOJ investigation of Jay Powell. Jeanine Pirro, who's the U.S. attorney for the District of Columbia, where that investigation is taking place,
Mhm.
is really doubling down on evidentiary issues. And it's not clear that there's any accommodation being made at this point. We'll see if that happens between now and Tuesday. I think also on Tuesday, watch for um, other senators trying to put Kevin Warsh on the record around Fed independence. There's great concerns on the Hill around that. And so pay attention to that. But long story short, it is possible that a vote comes out of the Senate Banking Committee that's 10-10, which
Mhm.
means he moves to the floor with an unfavorable recommendation. At the end of the day, I think the nomination goes through. It
Mhm.
may take a little time. The deadline, if there is one here, is May 15th. That's when Chairman Powell's term as chairman expires. The other interesting dynamic that's going on here is that that's the only thing that expires for Chairman Powell. He can remain on as governor until 2028. Historically, chairs, when they still have time on their governorship left, they just leave. Powell has indicated that he intends to stay insofar as the investigation into
Hmm.
him remains in place. And so we could be set up for a very interesting dynamic here where you have an incoming chair, and we're all humans, right? And this is a 12-member board where you have an incoming chair who has a split search committee,
Hmm.
if you will, on this board, and the old chair stays. Sets up an interesting dynamic where, frankly, I would love to be a fly on the wall of those FOMC meetings to understand those discussions. But I have no doubt that our friends in the media will write stories around palace intrigue and who's up, who's down, what's going on within the Fed that, frankly, won't be particularly constructive
Hmm.
to markets and ascertaining,
Yep.
where the direction of the Fed is. And so I think this is something to watch over the coming months is sort of those interpersonal relations. Forget the sort of we know where the economic data is, and I'm sort of
Hmm.
been of the view, given everything you guys have discussed today, what we've discussed vis-a-vis Iran, and the I'll describe it as warm employment print we had, a couple of weeks ago. It all sort of points to hold steady.
Yep.
And I'm not sure that I see a rate cut this year. Not that that's my job as a political analyst to call, but the dynamic on the Fed is going to be an interesting to watch for the coming months.
Yeah, and the shift in composition of the Fed, like you said, the ability to consolidate views. If you viewed Kevin Warsh coming in as a little bit of a, different-minded Fed chair than what, the rest of the members of the body, might be, there would obviously be some kind of good old-fashioned, building bridges and making relationships across the community to kind of present a unified policy approach. But, with the current data, the current, commodity supply shock, being what it is, some of those views might be a little bit more challenged to get implemented.
I think the jury is out on how he moves, and I agree entirely with you, Alan, that really the job of the Fed chairman is to try to drive consensus within
Hmm.
those governors and those bank presidents, and so and for all intents and purposes, I think he's well equipped to do that.
Yeah, I think you know, it's a challenging job, you know, regardless. I think political pressures make it even more challenging, and then you add these new inflation pressures, and
Hmm.
it's a tough time to be coming in as Fed chair. I would also mention that he's going to be taking the position on the board of governors
Hmm.
from Stephen Myron,
Hmm.
who was a temporary fill-in nominated by President Trump,
Hmm.
who was obviously an advocate for significant rate cuts over the
Hmm.
past 6 to 9 months. So he'll be leaving the Fed. He'll be replaced by Kevin Warsh, who, as Jason mentioned, has a history of being a hawk. His more recent comments suggest he thinks we're in a productivity boom,
Hmm.
right? A supply side productivity boom that will allow growth to stay strong while inflation comes down. That seems to be his core macro view right now,
Hmm.
that he'll be bringing to the committee. And again, he'll have to convince his colleagues. The other thing I'd mention is someone like Christopher Waller, right, who was a
Hmm.
finalist for the Fed chair job. He's been concerned about the labor market for a while now.
Hmm.
If you look at the last FOMC meeting in March, um, he did not vote for a rate cut. Right?
Hmm.
He went along with the consensus that rates should stay flat. So he's coming in at a time when even some natural, quote unquote allies for rate cuts
Hmm.
are sort of saying, hold on, let's pause on this thing and just see where this conflict and inflation goes from here. So again, this could change by
Hmm.
May. We'll see. But I think as of now, the way the committee's set up,
Hmm.
you throw in the Powell thing, and
Yeah.
there's lots of uncertainties around monetary policy that would suggest to us, I think, that rate volatility should probably go up, and we have seen it go up over the past couple months.
And something people don't focus on as much as part of the Fed's mandate is also the supervision of the banking system, supervision of the bank holding companies. And, if, kind of Kevin Warsh's, aims from a monetary policy perspective are somewhat complicated by the current situation, I'm wondering, what can we learn from kind of past public comments and past, views that he's expressed on sort of the supervisory aspect of the Fed from a more policy perspective, aside from the monetary policy? Is there anything that we can learn there, Jason?
Yeah, it's a great question. I think he's in the past had taken a sort of a deregulatory stance. I may be overstating it, but was somewhat critical of some of the post Dodd-Frank initiatives that have taken place, particularly around globally systemic financial institutions. But remember, there's also, Michelle Bowman is in place as the vice chair of supervision.
Mhm.
And my sense is, I don't, just a gut feeling is that he'll largely defer to her. I think they're pretty aligned in their supervision and regulatory views. Remember, this is a body that just reproposed a Basel capital regime for the larger financial institutions that was, I think it's fair to characterize as a lighter touch than what the Fed under Michael Barr had proposed. And so I think they're probably pretty aligned on their supervisory views. And look, as we've talked about, he's going to have his hands full. And
Mhm.
I think we'll probably do a lot of deferential treatment to the Vice Chair Bowman. Yeah.
All this is going on in the backdrop of a rapidly approaching 2026 midterm election. Where do things stand today in terms of expectations on the balance of power in Congress, and what that might mean for, some of the president's policy agenda going forward?
Yeah, so the Congress is the House, the entirety of the House of Representatives is up for re-election. A third of the Senate is. Both are in Republican hands. Republicans have a three-seat majority in the House. History, just pure history, forget the political dynamics and overlay, suggests that Republicans will lose control of the House. On average, since Reagan, the party in the White House has lost on average 21 seats in House midterm elections. If you're a Republican, the good news is there aren't that many seats in play. If you're a Democrat, the political dynamic is not great for the Republican Party. And sort of my base case is here that the House probably flips, that Leader Jeffries will become Speaker Jeffries and have a narrow majority, although it'll be more workable than the very extraordinarily, two-seat majority that Speaker Johnson currently enjoys, and I say enjoys with tongue firmly planted in cheek, because it's been very challenging for him. And so Jeffries, I think, will have a narrow majority, low double digits, and so that's a little more workable than what Johnson has.
Jason, as always, thanks for being a guest on the podcast. We'll have you back again. Your appearances are always greatly appreciated. And thanks for the insights that you have on all the policy and geopolitical uncertainty that we're experiencing right now.
Thanks for having me. It was great being with you guys again. Take care.
Thanks, Jason.
Andrew, thanks. Another great episode in the books. We'll cover more here in a couple of weeks.
Yeah, and just a reminder that the Q2 economic outlook is published on futurestandard.com. Sturdy under strain. Hopefully that continues. But feel free to go give it a read on our website.
A name and a mantra.
That's right. That's
Thanks,
right.
Andrew.